à Trois-Rivières.
Hi, my name is Reginald Pierre-Louis. I'm a tax consultant at Raymond Chabot Grant Thornton.
Sebastian Luna, I'm a senior consultant at Raymond Chabot Grant Thornton.
Imagine the smell of warm, fresh bread and pastries straight out of the oven, each one individually handcrafted by your bakers, Monsieur Légaré. This is the reputation that has helped you become a great bakery here in Trois-Rivières. And this individual personalized relationship you've built with all your clients is how we today, myself, Emily Chung, my colleagues, Dominic Frankie and Elsa Leach, would like to help you with your taxes. An individualized, personalized, fresh, and innovative tax advice session. So today we'll be able to do that by going over a few items. First, you brought forward some corporate considerations for us. We also have a few personal considerations you would like us to address, some rental considerations, and finally we have some succession considerations so that your company can continue to grow into the future and continue to flourish here in Trois-Rivières and maybe beyond. To begin, we'll go over some corporate considerations that you brought to us. Now, you mentioned that there was a CRA, Canada Revenue Agency assessment that came back to you with a few items that might need to be reconsidered, which could have created some taxes payable. However, we've determined that you are actually able to appeal these assessments, and you have 90 days from the date on the notice of assessment to appeal these. However, if that 90-day period has already passed, you actually can submit a written extension to the CRA just explaining why this might be coming in a bit later than that 90-day period. And that'll allow you to appeal any things that you don't agree with this new assessment. Now, you were worried that the Ministère du Revenu du Québec would also have similar issues, and this is very possible because there are similar laws between the two organizations. However, it really depends on the items that were reassessed by the CRA, so we'd have to look at those, and they would have similar tax consequences depending on what items it was that was reassessed.
So now we'll have a look at some different tax credits that are available to you to reduce your tax burden as a company. So first of all, we have the Scientific Research and Experimental Development Tax Credit, which is available to you because you have a research and development department in your company. So if if you use some money to fund any improvements for processes that are currently in your organization, these expenses and these capital costs can be used to incur. We can use a tax credit to decrease your taxes payable. So these the qualified expenses and capital costs are listed here. So the labor and wages of the workers that work on the improvement of your current processes, as well as the machinery. So the capital cost or the lease cost of these machinery. So next, we also have the investment tax credit, which is an addition to the CCA reduction. So we have the plant and equipment to develop new production chain and processes. The cost used to invest in these this plant and equipment, we can use a tax credit to reduce your taxes payable in the current year and reduce your tax burden for you. The qualified property that's qualified for this credit are the property that increases the efficiency and the development of your current products or new products. And it's a very advantageous credit because there is a large immediate deduction and it reduces your tax payable for your corporation.
There was also some items that you mentioned that your company was paying for in terms of meals and entertainment for whether it be clients or customers or yourself. So for client meals, you correctly deducted these at 50%. And there are sports season tickets to the Montreal teams. And this tax treatment really depends on who is receiving the tickets, because if it's the clients that are receiving them, you can deduct 50% because it is for the purpose of your business. However, if it is your employees that are receiving this, it is considered a gift to them. So it would be fully deductible for yourself. However, for the employees, again, it would be considered a gift, which is tax-free for up to $500. Anything beyond that of the value of the tickets would be considered a taxable benefit. Now there's also the company Christmas dinner, and luckily for you, it actually is fully deductible because when you're including all your employees, you are allowed to deduct the full expense and cost of the event. So this will decrease your taxes payable. Now shareholder meals are not deductible, and if you would like to have them be deducted, you should fund all the meals of all your shareholders and employees. Now there's a vehicle that you have been providing for one of your employees, and there are two options to consider here. You either can rent the automobile and provide it for your employee, or you can provide him with an allowance. Now under the renting option, you have to pay $550 per month, which is well below the $800 leasing allowance, and you add expenses of up to about $5,000 a year, and so a total cost of approximately $11,000. However, if you were to provide the flat rate employee allowance, you would only be paying about $900 per month, which is $10,000 approximately per year. So overall, we recommend the employee allowance because this has less liability, it is more affordable for your company, it is deductible for the corporation, and your salesperson can even deduct up to the amount of commission that he has earned.
So next you came to us with this employee, Jean, and you would like to involve him more in the operations of your company. So to do this, you would also like to make him a shareholder. So to do this, we have recommended that you use a stock option. So to do this, some of the benefits of this would be that you would ensure goal congruence between management and the company. It would also reinforce the employee retention and ensure that Jean stays with you into the future because he'd be a shareholder. And finally, it allows Jean to defer his tax because Jean would only pay tax on this taxable benefit when he sells these shares because it is a Canadian-controlled private corporation. So, another tip here is that the exercise price must be higher than the current fair market value of the shares, and this will just give Jean the motivation to work hard to increase your stock price. And this also supports your current company values of participative management, of encouraging everyone to participate, and encouraging increasing the integrity of your company. Next, we have some personal considerations you came to us with regarding your personal income tax return. So the first thing was that you came to us and you said that you have a large loan currently on your home. And now what we'd like to recommend is that you ensure that loans are for financing and not for your personal use property. This is important because loans for investments are deductible as an investment expense, and this would largely reduce your tax burden.
You also had a few shares that you were giving to your children as they reached a certain age. So this is considered a gift to your children, and it would be a deemed disposition on your end at fair market value. And there is a potential capital gain depending on when they were purchased. And so income attribution applies to this case because they are children and minors did not provide the consideration for the shares that they received. So to address this, the parents are legally responsible for all the applicable taxes. So yourself, Monsieur Légaré, will have to consider this, and it will be taxed at the parent's marginal rate. And the kiddie tax would apply, and that would be at the highest marginal rate as well. Now, you also have an appreciation for wine, which we all understand, and the good thing is that this is listed personal property. It's considered an investment, and all gains on the sale must be claimed. However, it is assuming that they will be increasing in value. So, and your losses on these wines will only be deductible against any gains that you had on these wines.
Now you also have a rental property, and we have some quick advice for you regarding the rental property. So first of all, the rental property is rented to your to a tenant. So you did expense the windows. So you did expense the renovations on your windows in your income statement, but this should be capitalized because it is a renovation and should be added back to the undepreciated capital cost of your building. Also, you have the land which sits with the building which sits on the land. You are currently deducting the capital cost allowance on the whole investment, so the land as well as the building. However, the land is a non-depreciable asset under tax law, so you cannot deduct CCA on the land, but only on the building. So this will result in increased tax payable in the past. So there might be taxes payable and interest and penalties on this mistake. However, there is a possibility to voluntarily disclose to the tax authorities that you have made a mistake, and this qualifies under the voluntary disclosures program at the CRA, and they will waive your interest and penalties if you decide to continue with this